you for joining our inaugural episode of the Wook Book Club. This is Rod Alsman. I'm the managing director at Wook Capital Management. And we're going to be having a conversation about 2 hours, is what we have planned for, on Richer, Wiser, Happier: How the World's Greatest Investors Win in Markets and Life by William Green. Found this to be an excellent read in that it dives into the successes that these brilliant investors have had in life beyond just their stock exploits. So I think that we will walk away from the conversation finding ways to feel rich that doesn't simply come with a dollar sign attached to it. Unfortunately, our founder and CIO, John Kim, has an urgent last-minute call with Korea that he's unable to back out of, and he won't be able to attend this inaugural session of the Wook Book Club, but we expect him in all subsequent ones. We will have this follow-up scheduled by shortly. We will be looking to do it in November. Obviously, you need to be doing it ahead of the Thanksgiving holidays. And we certainly value and appreciate any feedback that you have or any book ideas that you'd like to propose. The question list for this session can be found in the Wook Discord server in the book club under Richer, Wiser, Happier. I have pinned a list of question prompts to help the conversation. And with that intro, let's get underway.
Can you guys hear me? No problem. By the way, this is Han, part of the Wook team. Just investing is really about waiting for the right opportunity than anything. And I think throughout this book, the author really emphasizes the importance of saying no. And I think that's the message that all these investors echo as well. You know, they say it's a matter of waiting for the rare moments. And really working on yourself and developing good systems and habits so that when the right opportunity presents itself, we can jump on it. And this, honestly, it's really personal for me because my investing experience, probably like everyone else here, has been dominated by GameStop. And while it was a fantastic opportunity that helped us greatly, it didn't prepare me personally for the market that we see now, and I think it's a great opportunity now, to hone our skills and practice saying no, so that when these opportunities present themselves, we can take advantage of them. So that's kind of like the personal lesson that I really took away from this book.
You're right. Like, in many ways, GameStop January 21 was the culmination of the end of both the COVID period and perhaps to an extent this decade, plus long bull market. What worked then, right, is likely not to work going forward. And to Joe's idea of trying to locate perfection, what was perfection then will probably not be the same. It won't come in the same shape or form looking, into the future and hoping to find the next, great undervalued opportunity. At least I that's how I'm thinking about it a little bit. What do you guys think?
I think you're right about, GameStop was kind of this like fireworks show of the bull market. And I think it really epitomizes like, just how crazy the markets were just last year and how it's so different now. And I think anyone that, hopped on investing last year and really started off with these meme stocks and everything was rallying, and it was really a hard time to lose money in the market unless you were short. It's a totally different ball game, and pretty much everything you may have learned or you thought you learned isn't true anymore. So I agree with Han on that part.
Right. So I think
for
all of us who no, didn't mean to cut you off, Rod. Just wanted to bring up, I think, after reading this book, the main question that remained in my head is, how exactly can we prepare ourselves to, take away all these great advices from the greatest investors and prepare ourselves, right? And the first one is so interesting, Pavrai and the idea of cloning. So I just kind of want to, sorry, Rod. There was like a list of questions for yeah. So the
Notes.
idea of shameless cloning, I thought was so
Yeah.
interesting because it's something that we all do to some extent, but not with this intensity, right? So I would, personally, I was really amazed by his discipline, about how far he can take the idea of cloning and build his life and career out of it, and really own this philosophy of cloning. Really, that was really eye opening for me. I would love to hear thoughts from anyone else in this chat, about what they thought about the cloning philosophy of Pabrai, and how it resonated with them. Any kind of takeaways?
Going to be shy. Uh, I think it's like counter. I guess it's like counterintuitive. You think you need to be. You know, you might first think you need to be a super genius and have all these novel, creative ideas of your own to be successful, and then you have this man who, yes, he's clearly quite bright and he's been quite successful in his own career, but all by virtue of simply following other people's thoughts. And it just really goes to show you that there's something for everyone. I guess this approach may not work for you. I personally don't like cloning. I personally don't like it if I have an investment that everybody else has, or that a lot of people have, which isn't to say that I couldn't benefit from maybe finding some people whose ways of thinking align more with my own, and cloning them, or at least following their 13Fs or whatever other disclosure they have. um, but no, for me, cloning isn't the way. But that's not to say clearly it worked for Mr. Pabrai, and it still works for him, right? What about for you guys? For the rest of you, what do you think about this idea of the cloning?
I think it works really until it doesn't. I mean, you always hear about, especially when it comes to politicians, like making these plays, and there's always these Twitter bots that share when these big insider trades are made, and things like that. And I don't personally think they're really calling out the losers. It's really a lot of emphasis on the winners. So when you see someone who you're going to follow all their trades, you have to recognize you're going to follow their trades that turn out wrong as well. So it's just not my way of thinking.
I think cloning as an idea might be, so I think some people might be turned off the idea of cloning, but I think within the context of Pabrai, in the book he has these rules, for example, like rule number 3: treat life as a game, not as a survival contest or a battle to the death. Rule number 4: be in alignment with who you are. Don't do what you don't want to do or what's not right for you. So I think cloning within this context, kind of like first establishing solid rules, like Pabra is doing here, and then cloning, as long as you're kind of abiding by your own personal rules, I think is the most effective, because you would essentially be benchmarking all these really great ideas that have been tested and proven in the past, but you are kind of shaping them in your own way, by following these strict set of rules, that you can implement in your life. So I think there's a variety of ways to approach cloning, but for me, like how Pabrai is approaching cloning here through his own set of lens, I think is a really great approach to life in general.
That has his rules, so I put his rules up on the screen. And I think rule 2 is a great one that I really like. It's the idea that, you know, if you spend time with people that are smarter, better, whatever it is that you're trying to get improvement upon, and you spend time around them, it's only going to kind of pull you up, as opposed to, you know, if you're spending too much time maybe with people on the other end of the spectrum, you know, it's probably going to drag you down. But I think four probably, like you were saying, Han, you know, for me, it gets, you know, I shouldn't follow tech investors and try to clone them, because that's not who I am. You know, gets back to what you just said. Try to find people who really align with you. Yeah, let me find a better version of myself who aligns with me, and then I can just clone them. Life will be easy that way.
Right, exactly. I think, yeah, finding people who are better than you, and that, you know, who also have values that align with what you believe in, and cloning in that context sounds a lot nicer, I think, than just finding some random person who's wildly successful and doing exactly what they're doing.
I like rule number 2, actually. Hang out with people that are better than you. I think that's really reminds me of the saying that, like, you are who you surround yourself with. And if you really like spend your time with people that you may know from, you know, your past, your childhood, that really didn't grow up in the same way that you did and go down the same path, then you're not really going to be as focused and as streamlined maybe in your career as you could be. If you kind of surround yourself with people that are into the same things as you and into the same goals, and have the same like life philosophy, then I think you'll end up further along in your career than you would have been otherwise. But that I mean that also applies for investing and everything else. I think when we when I first invested in GameStop, and it's tough to not relate everything to GameStop, but that's really one of the best stories of investing. I spent so much time in these Roaring Kitty streams and on stock twits, and there's so many people that knew so much more than I did on the stock, and that's where I consumed my information. That's like who I talked to about it, and that's it's actually how I ended up meeting Rod and John and these other GameStop investors is through those channels and through following rule number 2, which was hanging out with people who better than me. So it definitely works.
I try to join in these different Twitter spaces, and, you know, there's a whole spectrum of them, but some of them you have like really like impressive people who they're freely just sharing, you know, what might otherwise be, you know, professional grade paid research. And, you know, for me, as somebody who does like Twitter a lot as a platform, you know, that's living by that example right there, trying to spend time in, like, I see the space sometimes. I remember spending time in some of the you know, AMC ape spaces, and it's like, what did I get from it? I didn't really get anything, obviously, because, you know, these aren't really constructive conversations for the most part. I got a better sense of why a lot of people maybe are into that, but, you know, what's the reason to keep doing that? You know, I wasn't learning anything new really, and yeah, I much prefer. I'd love, you know, to pull up my phone and see that there's a Twitter Spaces conversation going on, hosted by somebody who I know has much more experience than me, much more of a, you know, well of knowledge to draw upon than me, and those excite me. I mean, Rule 2 is absolutely a great one to follow. But to what Han was saying about like treat life as a game, not a survival contest or battle to death. I mean, yeah, it's like if every single day is like life or death, you're taking on insane amounts of risk, or you're in your, whether it's your investments or just in your lifestyle that you're living. I mean, you're probably not going to have as much fun. You might not be in the game for as long, uh, but you know, definitely good rules to live by. I'm just looking at my notes from the Pepperai chapter. Yeah, it was interesting. Like he, you know, he obviously in the chapter talked about how concentrated, you know, he was with his cloning, and also kind of talked about how he, you know, tried it. And I think it was not just him. This was something many of them talked about. Was, you know, look, if you have a day job, obviously that's one thing that you know, is going to consume a lot of time. If you're, whether you're, you know, privately an investor. Obviously, for me now, this is a full-time job, but I prefer to live a lot like what Pabrai does, where I have mostly an open calendar and I can spend a lot of time reading and taking in new information. Um, and I mean, I'm very fortunate in that I have that ability to do that. And he talks about the idea that once he has one man show, because people under him will wouldn't be able to do that, and try to bet as we grow our team. He actually that. So, I thought it was interesting to think about Buffett. I think he talks a lot about how much time he spends reading, and in the book it talks about Buffett playing bridge and doing things that you enjoy doing, not because you have to do them, but because you want to do them. Seems to be a consistent theme throughout the book, not just with Pabrai. Yeah, so I guess I'll pose a question then, and hopefully someone who's been mum thus far will chime in. But as I was just saying, he notes that he spends a lot of time just reading and researching things. I would ask, what are your favorite ways that you go about reading and researching companies? And there's no right or wrong answer. So
I'll chime in again, Rod. I think for me, I do it very differently than you do. I see how you research things. I watch you as you screen share, and you're always Googling, pulling up databases and resources, really rapid fire. And for me, I am newer to this than you are. I tend to spend a lot of time on Discord. I tend to talk to a lot of people that I know have more insight than me. So I'm not at that stage yet where I've developed my own strategies that I can pursue alone. So I'm still in like the whole like find a mentor kind of stage, and I do really appreciate like the resources that like Discord provides, and the amount of people I can talk to on there, and the amount of like different opinions I can get, and then put together my own opinion. So I don't listen to people word for word, and I don't look to anyone for their sole advice, but I'll put together different opinions from different people I trust, and then try to foster my own.
a lot of your contemporaries, by sure like to kind of go that route, that talking to peers and listening and reading what other people have to say is a big driver. And it makes sense as you build out your quiver of tools and resources. You may be able to rely more on your own primary, reading and whatnot. But I don't think that is kind of living by that rule too. If it's you're taking in the best of what people that have that skill set or who you trust what they have to say is an informed, well thought out view. You're getting more bang for your buck that way, right?
Yeah, I also think you no matter what kind of investor you are, you have to consider like other people's sentiment, because you can totally be right. You can you can do all the research, you can do all the look at all the financials and determine that like the stock's undervalued or this is a good play. But if other people don't agree with you, I mean, the stock's never going to go up. Like it's not it's not always logical, and that's to me why I try and engage other people think, and I try and look at momentum. I try and see like, are people talking about this right now? Is this got a lot of buzz? And if things are dying down, then to me, like if I see less people talking about it every day, it's not a bullish sign for me. Like I think you see the volume. There's a correlation there with like the volume on the stock.
So a book that I'm partially through kind of is what you were just saying, that you need to understand what is, you can look at financial statements and try and understand, okay, this is, how much profit or free cash flow or whatever, this is the return profile of the business, whatever. But understanding like what is baked into the expectation of the stock. I need to finish the book, but it kind of is like, not, to the point you just said, like eventually, I mean, I'm a firm believer that eventually price aligns with value, and that can take many years to do so. But I don't believe that, like if the stock is just printing money, right, and returning cash to shareholders, like eventually the price is going to go up, assuming all else equal, that it's underpriced. Like, you can like try and figure out the why. I mean, you're right. Sentiment's important, is very important in the short term, clearly, right? January 21 was a prime example of that. With GameStop, of course, as the example to kind of lean on. But I mean, that to me was the most legendary, the best example of how a rapid, incredible shift in sentiment can change price. And it was presumably and clearly it was built on the idea that there was a change that was coming in the business, obviously from January 13th or 11th, whatever day the settlement was, through to January 29th. Nothing had really happened yet, but the market was both baking in the sentiment as well as baking in the expectation that you would have a shift in strategy, an improvement in the e-commerce operations, whatever you want to say as to why it happened. But yeah, it's ignoring sentiment, I think, is something that I've been foolish enough to, right, like I should have not bought GameStop maybe in 2017, knowing how hated it was and how hated it continued to be for years to come. I mean, it shouldn't be the only consideration, but I think you're right. Sentiment, you should at least gauge it. You can look at things like stock twits and different social media platforms to try and gauge sentiment. You can look at analyst reports to try and see what the sell side analysts are doing. I saw a recent article that I thought was really interesting. I can't remember if it was Bloomberg or what, but it was talking about, I think it was John Authors, one of his newsletters, talking about the way in which sell side analysts ask questions. And I don't know if it was purely the words in the transcript or if it included kind of getting tone of voice, but just listening, just getting that could actually lead to edge, because you could see, like, if the sell side was really negative on the stock, generally the stock underperformed, and vice versa, which speaks to the reality that sentiment is something you can't ignore. But what else? What other, for folks, who haven't chimed in, how do you do your research? What are your favorite ways to research companies or read about them? Are you like Joe, or do you do more of your own primary, or I'm trying to prod you all into action?
Howdy. Being that I have a very limited amount of time that I can put into researching various investments, having a full-time day job, managing crews for construction and whatnot, I typically go off of like reading other people's due diligence, and then finding the good pieces and picking it apart and analyzing it myself.
Or what are your favorite?
That's how I do most of it.
Yeah, like what are your favorite platforms to look in?
Like GMEDD, I read what other people write on there. Reddit mostly. A lot of different kind of like social methods. I haven't really learned too much about fundamental analysis yet.
Makes a lot of sense. Lines with Joe a lot.
This question, Rod, reminds me of check page 169 on the book. That's kind of what I'm referring to here when I say the discussion about the investment world is filled with people who pretend they can see the future, see what the future holds. They include smooth-talking market strategists from Wall Street brokerage firms who confidently predict the precise percentage rise of the stock market in the coming year. Yeah, I think we saw that pretty good with, it looks like Well, I'm on 169. Maybe your chapters are different than mine. If you search pretend, maybe it'll come up. If you can do find in the book. Let's see.
Chapter. Oh, sorry. I found it.
Yeah, I'm looking at your screen.
This is it.
There it is. Yeah. So it reminds me of so much of the Viking stuff from over a year ago now. And you have these people that post online, people that post on Twitter or wherever, and they act like they have some crystal ball, or they say like really mysterious things that no one knows what the real meaning is, but people try and piece something together. I mean, people were doing that with Roaring Kitty when he was tweeting out cat gifs. Obviously, I don't think he was trying to manipulate people or anything like that. He was just having fun. But people always, you know, it's a lot of with the YouTube investing world too. I'm not personally a watcher of any YouTubers that do stock tips or anything like that, but people that are into AMCR and the amount of people that claim to know, like, oh, this day, this is, you know, MOAS soon, this is happening. It's crazy. I think this cycle, you know, this bearish cycle of the markets is going to dose some harsh reality to those people, and I think that's just how you become a better investor. Is you got to have a scenario like that or a situation where you take a big loss, and hopefully you know, then go read up, do some research, consider where you're getting your investing knowledge from.
So I was bringing up a page, and you can see the highlight on the right side. This is what you were just saying. Made me think about, you know, the folks you're kind of referring to. That's what, you know, they're doing. They're looking to actually reinforce what they already believe, opposed to genuinely trying to find new and potentially differing, you know, viewpoints. I've said it before. Like, the only reason I ever got involved with social media around investing in the first place was because I wanted to understand why everyone felt the way they did about GameStop, and I felt differently. And I really never got, other than kind of I understood on its face the logic that, yeah, physical gaming will be in a state of secular decline. It will eventually go the way of the dodo. But, you know, to me, it didn't make sense that the logic was that it's going to go out of business overnight or anything like that. And it felt like it was getting maybe overly sold off. And obviously, with hindsight, we know a lot of hedge funds were short physical retail, short specialty retail, and leaned hard on those trades, and they were long, very long e-commerce. And, you know, fast forward to now, and we see folks like Tiger Global down 62 whatever percent year to date. The folks who are all in on, you know, e-com and technology disruption and blah blah blah. You know, on Friday we talked about Kathy Wood, but, you know, I'm not trying to get on my own high horse about that, but I try very hard. I think it is harder to do than it sounds, and it is inherently uncomfortable to do, to go out of your way to find stuff that may say that what you are thinking is wrong. But that's what you need to do, not, you know, going on YouTube and, oh, let me listen to the guy I know is hyped up on whatever company that I already am hyped up on. Like, that's not constructive. It doesn't really give you anything. And it's dangerous, right? Because then you may just think, oh, well, everyone is saying it's a great thing, you know, that I'm listening to, right?
Yeah. Yeah, totally. I think you see that with the cults that develop around certain retail stocks. I won't disclose the names of them, but whenever I tweet something that's, you know, not even trying to be bearish, but I'll just tweet like the most factual news that I can come up with on the GMEDD Twitter account, and the people like say, "Oh, you're a hedgy, you're bought out, you're a shill." No, I've found this news. I have no obligation to only share bullish stuff. If I see something that's bearish, but you should know this as an investor, it's my obligation to share it. Like, if I only shared things that were bullish, then I'd be no better than anyone else. I mean, it's takes seeing both sides of it. I think if there's someone that departs from the company and I covered it when they were hired, it's only fair I'm going to cover it when they're fired or departed or wherever they leave to go back to Amazon or wherever they came from. I think it's relevant. I think people should know that. It's a shame that a lot of people don't want to see both sides and they just kind of want to put on these like foggy lenses of only reading things that are bullish. I don't like that. I think it's important to see both sides of the picture. I think I'm not personally a shareholder of GameStop at the moment, so it makes it easier for me to share things that go side to side. So like I don't have any reason to only share bullish sentiment personally. So that's part of why I'm so okay, like, you know, sharing anything that comes up, any news that I can find.
Keep moving along then with kind of the chapter by chapter, and we can kind of go all over the place too. I don't mean it to be too structured, but the temple chapter 2. So, you know, I guess this question is kind of in line with what we were just talking about. If you Green refers to investors in his book as non-tribal free thinkers that care more about being right than social approval, which, I mean, if you're trying to get YouTube views, you're trying to get social approval. You're not trying to necessarily be purely objective, right? And I think the question I would pose for everyone is, how do you, like, I hate to use the word contrarian, right? And people are like, oh, I'm a contrarian. It's like, well, you're probably not. I hate calling myself a contrarian, but I certainly am not one to go along with the status quo. So I guess, you know, the logic is that it's easiest to always just go along with the status quo. And if you're not, how do you do it? As Templeton, or rather as Lipper noted of Templeton, Soros and Buffett, the willingness to be lonely, the willingness to take a position that others don't think is too bright. They have an inner conviction that a lot of people do not have. How do you get to that point? Not just go along with the status quo. I mean, the book definitely talks about, and I think there's a lot of validity to the being unemotional about it as best you can, right? You know, obviously, again, to kind of cite the meme stocks a little bit, there's a lot of very deep set emotional connections that people are establishing or have built up around the investments that they have. And those should have nothing to do with whether those securities are good investments and offer attractive risk returns, right? But I think trying to turn off your emotions as much as possible when you're looking at this stuff is vitally important. I mean, hard. I don't like some of the things people say about me on social media, but you know, I try to be unemotional as best I can. It's definitely just like trying to remember that, you know, to be right, and you know, I don't see how my emotions are, I guess, helping with that. My pursuit of being right. I don't know.
Yeah, I think it definitely takes some years. It takes some harsh experiences to really begin to take emotion out of it. I think everyone's first few years on the market, it's pure emotion. It's pure watching that, you know, line go up and down and making those decisions in the moment and not, you know, having that courage to hold on when things don't go right. So I think it's something that comes over time. willingness to be lonely. You're not going to have that right off the start. I mean, no one, gets into the market and makes a trade that they don't see other people doing. So it's something you really, really takes time.
Right. So I think willingness to be lonely, I think there's another layer to this. It's not only just willingness to be lonely, but willingness to keep up the discipline to stay lonely and keep up the conviction so that you hold on to your thesis even though the market's saying otherwise. So that's like we can just go back to the GameStop example. Like Rod, you were very early investor in GameStop, and you had told me shared the story of being the lone investor for a very, very long time. You saw price go down significantly, but you still held on. But I think, of course, correct me if I'm wrong, but I think the main reason that you are able to do that is kind of your discipline to keep the due diligence going and obsessively gather all these details about the company to support your thesis. And at the end of the day, that information gave you the conviction to hold on to the investor to the investment. I think so. So I think the most important thing, on top of the willingness to stay lonely, is the willingness to be obsessive about research and due diligence and be and continue pouring 100% effort into finding the smallest details until the market understands your thesis and you're proven right.
I think there's also opportunities in being lonely and being the lone, investor. Like Rod, back when it was just you and a small collective of other really enthusiastic investors in GameStop, you were actually able to get in touch with investor relations. This is like October of 2020.
Talk to them
And
was
actually,
May.
I think I don't know if you had a phone call. I believe it was a phone call.
I remember I was living
Oh,
in
that
New
was
York at the
May?
time. It was early on in COVID. I remember talking to, oh Jesus, I forget the guy's name. I remember talking to that guy at IR in May. It was like after the second quarter, I think it was results. That was the first time, yeah. But I think that is a very uncommon. I don't think many. Look, I have my own professional experience that helped me a lot because I worked very closely with investor relations at Ryder while I was there, and I was literally listening to earnings calls on a quarterly basis for competitor and peer companies for a few years when I was the competitive intelligence manager. So like that's stuff that not everybody has. And again, I'm trying to share my thinking and like things that I've found to be useful with other retail investors because I genuinely believe that we can all learn from one another and become better investors. But knowing that you can reach out to investor relations and ask certain questions and knowing how to ask questions in a way that you obviously can't ask for MNPI, material non-public information, but you can ask like certain lines of questioning to elucidate an answer that, or elicit, excuse me, an answer that maybe will give you some incremental nugget of knowledge. Like that is something that I wouldn't have known prior to spending my time at Ryder. So like going back to what you said earlier, Joe, as a younger investor, you won't necessarily have built up that knowledge base. But we do. Retail investors do have the ability to do these things that institutional investors can. And you may not get as far, but what if that company doesn't want to talk to an interested investor? Like that's probably a red flag on its own. I pulled this up on the screen and I thought it was a good line as well, kind of in line with this discussion. Quote, a necessary characteristic of great investors is that they can't be overly influenced by what other people think. The easiest way not to be overly influenced by what other people think is not to be aware of what they think. if you don't really notice that and don't really care about what other people think, that will make it easier to be a great investor. So it kind of goes actually against the notion of there being much value in trying to find what everyone else is thinking about a security when you're analyzing it, because what is that really going to tell you? I mean, it'll inform you about sentiment, which we can agree is something. But in a real long-term investment, sentiment doesn't mean anything. Actually, you don't want to be buying stocks that have great sentiment if you're looking to buy and hold with a 5, 10, whatever year duration, right? Because if sentiment is astronomically high, then there's really only one direction for it to go. Obviously, not all stocks with low sentiment recover or rebound or reorient themselves in a great way, but yeah. Really interesting. I didn't know about Templeton's this World War II bet that he made till reading the book. So I'll ask the question: what do you think about it, and how do you think that you'd have reacted at the time, facing down World War II and all of that uncertainty in the world? And let me try to get to the page that talks a little bit about it. So I'll read and let folks chime in after I read this off of it. So Templeton opened the Wall Street Journal and identified 104 American companies that had experienced, quote, such a terrible depression that their stock traded at $1 or less. A couple days later, he called a stockbroker who'd been his boss at Fenner and Bean and asked to invest $100 in each of those companies. He called me back and said, quote, that's a very unusual order, but we're going ahead with it, except we've eliminated 37 companies that are already in bankruptcy. And I said, oh no, don't eliminate those. They may recover. Pretty ballsy. What do you think? My hearing crickets will keep drawing on this until I get a response. So on the other side of the page, it talks about how psychologically it's tough to love a money-losing company that's burned all of its investors. If you're talking about these 104 stocks that are at $1 or less, they probably didn't become publicly traded companies in 1938 or 9, whatever year it was, at $1. So they probably had already burned all of their investors, right? But I think that his comment, and this is really vital, is the potential on the upside was much greater than on the downside. Sure, I may lose my $100, but if I don't lose my $100, I might make a lot. And in his as the story goes, the railroads did great during the war, and the one stock that was trading at 12 cents bounced to $5 before he cashed out. Pretty incredible return. And within 4 years thereafter, it went up to 105. So even though he made 40x, if he just held on for 4 more years, that 5 would have gone up another 21x, which is a pretty good return. But I don't know. I don't think I would have had I'm not sure that I would have had the ability to just buy all of these super cheap and chunk of them in bankruptcy companies heading into World War II. Yeah, it was 1939. Looks like. I think the impressive part too, to me, is that he wasn't even. It's not as though he had a ton of investment experience heading into that. It was the view that it's just this, I guess, inherent optimism that I know Buffett has about at least America in particular, right? The idea that things will always be getting better, and even when times are bad, there's which right, if it's, think 2009, all the banks, some banks are starting to fail, and everyone's losing their jobs and the market is falling apart, and it's very easy to sell everything. I don't want any more pain. Who knows what's going to happen next, but just like with 1939, obviously Templeton didn't know how World War II would play out. Just like no one knew precisely what would happen after the GFC. I think having that view that in the long run, it might take years, it might take decades, but humans are pretty ingenuitive and usually move the ball forward. I was reading an article talking about the refrigerator, for example, just the simple refrigerator as an appliance, and the idea that 100 years ago that was something only for the ultra rich, and now even if you're living in poverty, you have a refrigerator in your home, and that is just a proxy for progress. Just a very simple one appliance example. We're in incredible times. The amount of progress has happened just in the last, say, 10 years in technology. You look at a movie from 2012 and the visual quality, it's incredible how far it's advanced in just 10 years. And then you think, well, wow, 10 years from now, further out, then what? 50 years, then what? You might not know exactly what, but it's a safe bet that it's going to be an improvement, barring mutually assured destruction, right? Then continuing, here, what you typed in. So much bearishness already. How much is priced in already? It's obviously never a precise answer to that, but we can at least observe things, right? You can observe what the Fed funds futures market's pricing in from a yield curve perspective, and how does your view compare? I think the book does correct about you shouldn't really be overly obsessed about all these macroeconomic things, because I think Howard is right. Nobody knows the future, but we can observe, right, what is priced in to an extent, even if we don't know where things are going. And at one point there will be a peak of bearishness, right? There'll be more than what is coming, assuming that there's a recession. We'll get discounted, right? And then you'll have incredible return opportunities from that point forward, right? Test Mr. DCC. I need you to introduce yourself when you get a chance, but I will give you the Wookie role so that you can. Well, I'm not sure it's let me. Smartphone. Joe, I don't know if you can give DCC the Wookie role so that he can chime in. He needs to. There he is.
You can hear me?
I can.
All right, thanks. Yeah, hey, I wanted to mention something about Monish Pabrai that I didn't get because I didn't have the role back then. But I think one of the things that Monish says is that as a retail investor, if you've got a full-time job that's outside of investing, that's actually one of your strengths, because it's a lot easier to ignore the movements of the market and focus on your day job, because watching a chart every day can the market's supposed to serve you, and it really is, I think, wrong to try and let the actions of others dictate how you should act. And so I think that's one of the nice things I've learned from Monish is to basically just focus on, find a good investment and invest in it, but then ignore it and let it do its job. And it's quite a bit easier to do that if you've got a full-time job or something that is outside of investing that allows you to to take your mind off of it every day.
If you're staring obsessively at prices on a daily basis, it's not informing you about anything useful. It informs you of what the current bid ask is on the security. It doesn't tell you anything about how the actual business is operating per se, or what the outlook for that business is. Or and I guess another point is that it's very easy, I think, with kind of the manic market of COVID, to think, it was a 6-month investment. That's actually not an investment, right? Like, I guess everyone's definition is going to be a little bit different, but I'm sure that most of the investors in the book would agree, and I know some of them have some explicit quotes on it, but kind of like the time horizon we're looking at, because it all boils down to, and I think McBride talks about that. And I was just looking at my notes. He specifically says, right, that the Buffett approach, right? You're buying a business. You're not just buying a piece of paper hoping that the price goes up. You're buying. You may not be even a 0.0 whatever 1% owner of the business, but you're buying a business, and you're buying that business for a lot, a nice discount. They all kind of talk about that, right? You shouldn't be buying it when all of the best is already priced in. But yeah, I think that's a great point. If you're obsessively following the market, I think you're going to be tempted into over trading, and maybe people would benefit. I think most people would definitely benefit from looking at stock quotes less frequently, and really just following the business.
Yeah, and I think that and then there is a point where I believe that you actually can know too much about the business, where you could have, like, the fundamentals show that sales are improving, that maybe they're expanding their footprints and growing that way. But sometimes when we focus very, very minutely on a business, we can let something that's really basically a non-event, we could overblow it, overthink it, and let that change our whole outlook on the whole business, while mostly it would be immaterial. And I think actually one example of that, I mean, this is like really current, but a lot of people right now talk about Facebook and Meta and all their work with the virtual reality. But as far as like a contributor to the company, it's actually still kind of small. And if they decided to cut that, all those costs would pretty much disappear pretty quickly. So I think like that's an example where people might focus very heavily on something that, as far as the whole company's perspective, is actually kind of still a very small percentage. I mean, like in that example of Meta, I don't think it's inconsequential. I think it is important to notice it, but I also don't think that should necessarily sway your full
determine at any
investment
point
thesis.
in time to cut back on how many billions he's investing in Reality Labs, and he has, I'm sure he has some contractual commitments to continue to invest. But if a year from now he makes a determination that's not in fact the future, that is not a moneymaker for the business. It's a cost center, like you said. The business is the family of apps, and the advertising, cash flows that they're generating off of our consumer eyeballs. And yeah, I think you're right on the dot with that, DCC, that people obsess a little, maybe too much about Reality Labs, and they see whatever news bite comes through. Oh, they're pricing the Oculus, whatever at 1,500. Oh my God, this thing's a zero. Like, just hyperbolic overreactions to things, and that inherently it's going to be very hard at that moment in time to know if it will or won't be, where on the spectrum of outcomes it's going to be. And that's where a lot of them talk about, trying to be probabilistic in your thinking. And it's harder than it sounds to say, oh yeah, Reality Labs has this % chance of being a complete zero, and this % chance of being a share leader in 5 years, 10 years, whatever. I mean, that should be something you think about, but I agree 100%. People shouldn't be over obsessing about some small news items. sometimes in the context of what it really contributes to the business.
Yeah. On the segment of John Templeton, and that it is crazy. I wanted to laugh, but I didn't have the microphone. But it's crazy. His 100 by 100, I think it was 100 stocks with $100 on each. And there's a similar one that's it's kind of like that, which is I can't remember his name now, but he has, it's like called the Magic Rule, Joel Greenblatt, I think. And basically he's got a magic formula, and this magic formula will tell you like 30 stocks that are trading. Basically it's kind of like his version of a net, and his approach is he has a website, I think magicformula.com or something, you can Google it, but his approach is basically invest an equal sum in each one of these and then wait, and that a couple of them will maybe go to zero, but a few of them might make up for all of them. And it's quite similar to what John Templeton did.
That Greenblatt has in that formula, it's earnings yield and return on tangible capital as a proxy for capital efficiency. Yeah, as the book notes, right, he found that this was a simple systematic way of fitting through really priced securities with just those two metrics. Quote, it validated the market. It was a startling testament to the power of simplicity, right? We don't need to build these multi-sheet, complex models sometimes maybe to determine if something's attractive or not. That formula, testament to do it yourself.
Yeah. So like I don't. Sorry. I was just saying, like I'm not trying to advertise his approach, and there's some part about small market efficiencies where it says, hey, if somebody advertises this special magic formula, then the specialization will erode away as more people use it. But there's that kind of a bet I don't think is as crazy as it seems, right? Because you're saying, hey, the worst is already priced in, and right. I think that kind of helps with that outside thinking. I know there's a stock that I was talking to Uber about a while back where I said, I think this looks interesting, and I remember you saying that that seems like a terrible investment. The consumers in that for that business are just going to get destroyed by rising inflation. But I still invested in it anyways, and because I kind of had the idea that I don't, what Uber was telling me, to me, didn't seem like a view that required extremely deep thought, and I don't mean this in any offensive way. And so because of that, I thought, well, I bet most people are also thinking that, and maybe that's why it's priced the way it is, right? And so this is something where I figured, well, I can buy, a couple percent and sit on it and wait. This particular company has no debt, it's expanding stores, right? And so like the company's not going to go bankrupt. There's, it felt like it's pretty safe. And I think that there are quite a few businesses like that you look around and you think, well, if you have duration, then sit on it for 5 years and see where it goes.
Right. What's the duration in question? I don't even remember which security it was. I'm thinking it was a retail play. Was it City Trends or something like that? Yeah. So like my remark about my view obviously was more short-term oriented, right? And your point there that there are attractive aspects of the business, that the balance sheet was healthy, that even though my short-term concerns were probably being priced in, right, by many other people in the market, that maybe negative sentiment, yeah, if you have a long duration, and maybe you can deal with it drawing down because maybe that sentiment gets worse, and maybe the consumer gets worse in the short run, whatever, and it gets back to the importance of knowing what are you buying it for, right? Are you buying it to actually hold this as a business investment, or are you just trying to see what the price was in the short run? And my reaction was probably more about short-term thinking, and yeah, I think that's a great example of it.
Well, yeah, and I think your reaction was I should be able to buy it cheaper sooner, which I think is not wrong. In fact, it's gone down since I bought it, but I didn't size into it very heavily, and so that was something where I thought, yeah, if it goes down, and I looked at it like if it goes down by 50%, then that's when I'll add more, as my margin of safety, as I consider it, increases. So, but I also didn't mind paying the price that I did pay, because
still get a good return.
It still
over,
seems like
your expected
as a growth story
from where you bought it. Exactly. Yeah.
Yes. Right. Right.
Yeah, I think that it's to say that, and I see this a lot on Twitter, right, and all across social media, that people might have a viewpoint on something, but understanding like what is the actual time period and duration, like is it a true investment duration, and to the what you just said, it could always get cheaper, and if so, your margin of safety should be growing for any subsequent reinvestment or added investment. So like that gets into stuff about position sizing and entry and exit and all that, but I think that's a really key thing. Is I always see like a lot of fights and arguments when people are just talking about two different things with regard to duration.
Yeah, and coming back to that, retail viewpoint where you have a full-time job, I look at it as my employer. If I'm running a fund, my employer is my limited partner, and they keep investing in, providing me fresh capital every paycheck that I can continue to add to. So if you've got a 5-year duration, even if I used all my cash today, in 6 months or 1 year from now, I should have more cash that I can deploy, versus, somebody may be running a book that is a fixed amount of capital to begin with no expectation that they'll get new capital.
And they might
that's a
lose
much
capital
more difficult
because
game
they
to play.
underperform, right?
But if you're able to, yes, yeah, if you have no way to continue adding chips to your stack, like like a poker game, it gets continuously harder. So and I think that really does speak to duration. I had a friend who he quit his job to go full-time trading, and that was the advice that I gave him, was that I think if you can keep your job, because you've got somebody giving you more chips every couple weeks, and that adds you some safety. It means that if your trades blow up, you're not screwed. It also allows you to grow your pot essentially in 2 ways, hopefully. But if one of them doesn't work out, the other, the job
really,
will.
like vital, this idea that I'm sure most of us that are in this room right now, right, we have a full-time job and we have a check coming in regularly, and we can benefit from continuing to make investments over time, dollar cost averaging. We're not, unless we're talking about Wook in particular, we're not managing, a pot of money that we, to worry about. Thankfully for Wook, right, we're private. We're not beholden to, external investors who are going to be like, oh, you lagged this benchmark or this, index, and we're going to pull our money. So we don't have that. The book definitely very well I'm trying to remember. It's the chapter with the French man. I can't think of his last name. Jean-Marie Abelard. But just I think he lived that, right? Like he was working in kind of the professional Wall Street, whatever. And it's like, oh, if you didn't buy technology stocks in 1996, 7, 8, you were trailing everybody, and investors might want their money back. And unfortunately, right, a lot of the times people are piling in at the top, and it takes a lot of discipline, like he showed, to really adhere to your intellectual framework that you're following, and be committed to following on your principles and your strategy, and not just going along with the wave of what everyone else is doing. Right, like obviously Kathy Wood's ARC, innovation was, you could never own enough of it, and everyone needed to bid it up, and we can clearly see how it went over the last 5 years, right? As COVID hit, everyone had to own innovation. They bid it up through the roof. It 4x'd from COVID trough levels, and it's more than round tripped, and it's back at 2017, 2018 levels. And who knows precisely what comes next for ARC. Still, as we noted on Friday, is taking in more capital. It's an ETF. It's a little bit different structure, but I think that's a superpower that most retail investors should take full advantage of. They don't have to chase what's hot. They don't have to worry about underperforming a benchmark and seeing their money taken by the limited partners or whatever. And they can stand pat if they have a longer term view. And maybe the view was go mostly to cash in 2019, because you thought markets were very richly valued, and you had to sit back and watch 2020, 21 happen. And now maybe you've been vindicated to an extent. But all, to me, it gets back to that really vital word, duration. What is your duration? And for retail investors that are actually trying to act as investors, that is definitely a superpower that they can have over professionals. They don't have to worry about the 1-year return. You don't have to worry about those other short-termist things. I asked the question in the chat, DCC. I don't know if you saw it.
Yeah, but no, I didn't see. What's the question? What about other opportunities coming up while holding? Is this something you really, really love, or just maybe an opportunity you haven't seen now? Well, that speaks to where I get the incremental capital. So, Monish talks about, if you're, he has a rule, a personal rule that he says, if I'm going to buy something, I won't sell it for 2 years. And that is somewhat similar to Buffett had shared an example, what he called like punch card investing. It's like if you started your investing career and somebody gave you a punch card and said, each time you buy a business or a fractional share of the business, you have to punch a hole in this card. Most people would be much more careful with what they're investing in, and they would think a lot deeper. But when they do, they would have to hold it. And so that kind of speaks a little bit to other opportunities coming up. I don't want to necessarily restart that clock, so it could take a couple of years, for an investment to play out. And if another one looks really great, I might just be I don't know. I could be restarting that multi-year clock by moving to the next one. I think certainly there was periods at COVID troughs where maybe people traded up to a better quality business. There's no absolutes, but I think that it's kind of that long-term mindset and trying to think about it. I think the other scenario that Buffett has shared was that if I told you I'll give you a blank check, you can buy any car that you want, what would you buy? And then if I added a special rule that said, and that's going to be the only car for the rest of your life, people would change what car that they're buying, and they immediately would open up that owner's manual and try and read every page, because that thing better last. And I think it's really similar to that idea of that long-term investing, that if you're going to buy something and almost, never sell it. I mean, that's where Buffett's transitioned to, is just, I'm gonna own a big business, or sorry, I'm going to buy a business, and I'm going to own it. And if I like the business, why would I ever want to sell it? And if you have incremental capital coming in, you don't really need to sell it. Maybe you sell it if something really terribly changed or new management came in that you didn't see eye to eye with, like terribly didn't see eye to eye with. But also, if you're able to buy a business that an idiot can run, then maybe you can outlast the terrible management. I think Uber. I think you're in a situation. You're dealing with a situation like that, trying to outlast
a particular
management.
security that we all know what we're referring to. But yes, management. I mean, like it or not, I think like clearly with Buffett, what he's talking about there is like if you're truly looking to buy and never sell the business with a very much an owner's mindset, then you want a business an idiot could run. Because eventually they're going to come along, I think he says, right? I feel very strongly, right, about Playboy, right? PLBY, that it's very poorly run right now. You could almost argue that it's actively being self-sabotaged. Perhaps it is, perhaps it isn't. But I view that the asset base is grossly mispriced. I think sentiment is pretty much in the in the shitter, if you will. So when I think about things like that, when I think about a discount to a liquidation value, a pretty steep one, I think about sentiment having nowhere to go but up or sideways. And I think about can you get worse management from there? I don't think so. Right. That leads me to believe that the forward return should be attractive. Now that particular security has its own balance sheet question marks and income statement question marks, and there's a lot of noisiness around it, but like generally speaking, I'd rather be buying it when everyone hates it and when it's been run poorly, assuming there's no existential threat to it, which there's maybe a small chance of bankruptcy in that company's case. That is a real chance. But on the other hand, I'd rather not be buying it when it's priced for perfection and everyone loves it. I'm going to kind of go forward to chapter 3 with Howard Marks, and I know John wasn't able to join, and I would have loved to have John share some of his thinking. John had a chance to meet with Howard a few months back, and John's always looked up to Howard, and Howard writes these fantastic investment memos. If you've never read any of his memos, you're missing out. I would encourage you to do so. It's fantastic reading. But one of the things he talks about, and that that Manish was talking about, and many of them talk about, is like this idea, that you need to be looking where people are not, right? If you're looking at these mega cap tech companies, it's like what likelihood are you to have any sort of an edge over the thousands of other professional analysts and investors who've been monitoring Apple, Amazon, Google,
right. Duration might be your only edge. I think duration might be your only edge on those. Yeah.
So I guess I was trying to go to another question with it. I guess it's not really a question. Well, I'll pose this one, because he talks about obviously looking for less efficient markets, and I'll admit I'm less comfortable looking abroad than I should be, right? Where most of us, I think, tuning in are probably stateside, and we invest in what we know, and obviously the U.S. has benefited in the very recent term, with the U.S. dollar being king of everything, and as it rises, other markets have become less attractive because of their earnings, especially if they have dollar-denominated debt, blah blah blah. But okay, not to go on a sidetrack. The common thread in Howard's thinking and in all these investors' thinking is buying assets below their intrinsic value. And what kind of a discount do you look for when you're looking at stocks? Do you think about, like, I need to be buying this at 40% off, 50% off? Like, if I think it really should be worth 100, am I only buying it when it's 50? Am I only buying it when it's 40, 30? How do you guys think about that stuff?
I think it's based on the quality of the business. So, I mean, in your PLBY example, knowing what we know today, that margin of safety should be pretty high. But if you've got a company with management that's continuing to show over time that they are competent and follow through with their publicly announced plans, I think maybe that margin of safety can be a little bit smaller. Charlie Munger talks about they paid up for See's Candy, but had See's actually asked for a little bit more, they both of them, or at least Warren, would have said no, and that turned out to be one of their best investments ever.
This book, I know exactly what you're talking about. It is a good one. With See's. Well, I would ask the question, like, I see Buffett had bought a lot of Apple recently this year, and I actually couldn't understand it, except maybe on a really, really, really long duration. Like, why would you be buying Apple at these current levels? And maybe Warren's logic is, well, they have this incredibly attractive cell phone driven ecosystem that brings customers in, and they're very sticky, and there's a lot of ways they can sell a whole lot of different goods and services to them, and that flywheel will spin for many years to come. But that obviously then gets back to the duration, and I think of Apple, and I don't disagree with the idea that it's an incredible company that has some incredible products. But then I go back to what discount would I need to be buying it at? What do I think it's worth, right? What do I think the value is of Apple today? And what would I be willing to pay to buy Apple today, right? So I guess I could, just using Apple as an example, we could use any stock as an example. But like, I would want more of a discount to be buying Apple personally. Right? What do you guys think?
I actually kind of have a similar story here, but it's more in a private like acquisition of YouTube when it was private. Google bought them in, let's see, it was, I don't get the exact year wrong, but it originally in 2006, Google had first talked about acquiring YouTube, and they thought it would cost them $50 million. That's what they were willing to pay, and that's what they had valued the company at, was YouTube at $50 million. This was in 2006. A year passed, just over a year, and they ended up paying over $1.6 billion. So, I mean, that's a huge, huge amount of money over what they're originally valuing the company at. But it still turned out to be an incredibly successful for Google. I mean, it's like one of their most valued acquisition. Like, it's one of the, I think it is actually one of the most viewed websites. It's up there. It's in the top 3, I think, alongside Google. So it was definitely a worthwhile purchase for them. But it goes to show, like, even if you do pay up, if that thesis remains true, it doesn't exactly invalidate anything just because it costs more. What do you think about, like, Apple, though? Apple is definitely a different story, but you'll see, I see looking at 10 greatest acquisitions of all time. Yeah, YouTube's up there for sure. And I see Instagram acquired by Facebook for $1 billion, and DoubleClick.
Is it that they only paid $50 million? Google only paid $50 million to acquire Android. Think about how much
it's crazy.
that whole Android OS just has opened up for Google. Incredible. I mean, they've got 4 of the top 10 in this particular list, and this is not scientific. Obviously, it's just somebody's list they put together, but incredible.
Yeah, but it's pretty obvious that Android wouldn't have gotten anywhere close to where it is if it wasn't for Google acquiring them. I mean, they just opened up so much more capital. Like, they may have paid $50 million for it, but how much have they invested in it? So much.
Not 9:30. It's 9:30 Eastern. It's I'm in Las Vegas right now. So I think we'll run another up to maybe 30 minutes and keep this conversation going and try to cut it at the 2-hour mark. I appreciate those of you live and taking time out of your evening. I definitely understand many of you have full-time jobs and you might have just tuned into this after you got off work. So we'll go for 30 minutes here, and then we'll let you have your evening back. And for folks listening to the recording, we are going to make it available for Wookiees to listen after the whether we make it available on YouTube or elsewhere, we'll communicate that. But we want to do more of these, and obviously we'll welcome any ideas for the next book or any other books that we may want to cover. Them in the Discord if you'd like, or on Twitter if you'd like, whatever your preference is. I have a few in mind. My hope is to settle on it by, if not this Friday, by next Friday, so that people have several weeks at least to turn around and get that reading done for next month. Okay, so let me think about some of these questions that I'd like to get some responses to. Yeah, this is a good one, and I'll share my own experience on it. So Evilard talked about avoiding disaster, and a few of them talk about avoiding disaster and catastrophe. And I would ask, are there any disasters you've been involved in or that you were able to successfully avoid? And what disasters do you see out there? And I'll share. I remember, going back to Joe's point of, sometimes you need to just live it to learn it. I remember being in senior year in high school. I had opened up a Zecco account, which was the first free trading account. This is 2007, 2006. So Zecco, it was, no commission on stock. And I think with options, it might've been like $1 per contract, which at the time was like stupidly cheap. Lo and behold, they got bought by Trade King a few years later, who then got bought by Ally, and that's now Ally Invest. Side note. But I remember buying. If anyone remembers Dry Ships, DRYS, that was a I don't want to call it a meme stock because I don't think they used the term back then, but it was like a super popular retail stock that I got in trouble in 2007 buying options. And you can see from the chart I just pulled up, if you're able to see my screen, let me get back to the max. You can see that it had quite a wild run. The price looks goofy because the stock ended up doing a bunch of reverse splits into infinity. So the numbers don't make any sense. 1.2 billion price. I can assure you that was not the price of Dry Ships when I was buying it in 2007.
Oh no! Wait till the GameStop investors see this.
Call options. I didn't have a robust understanding of what risks one is taking on when you're taking on these high decay, high leverage positions, and I blew up a trading account that was like $5,000 or $6,000 or $7,000 that would have really been helpful to pay tuition and room and board and have less than student loan debt when I graduated. But look, you see this thing start going up and up and up, right? And that it's very easy, that emotional allure of, oh my God, I'm going to get rich quick. I'm going to time this perfectly. I'm going to buy it and know how to get out at the top. And I didn't, and I blew up my account and the options all went to zero. And that was a disaster, self-inflicted wound. It was a great learning experience. I think I can safely say, in retrospect, it was a good thing to have had that happen to me. But yeah, I guess I shared my personal disaster. Any other either a disaster you've experienced firsthand or observed firsthand or that you see out there right now that's a disaster waiting to happen?
Rod, I know you want to say Tesla, but there's a lot of people that are on the other side of that trade.
Tesla's got a lot of transient benefits that happened during COVID, right? You had the fact that semiconductor chips for like your basic automotive chips were in super short supply, but because Tesla's the way in which they architectured the software of their system, they were able to be, I think, a lot more flexible with their chips, and they didn't run into the same shortfalls as other automakers. Obviously, with other automakers not being able to produce cars, the limited supply of cars, and maybe the quantity of cars demanded, went up slightly, right? With everybody getting so much money from stimulus and maybe not having spent money elsewhere, right? So I think Tesla had a lot of benefits, and obviously then now with like Inflation Reduction Act and a lot of the pushes for vehicle electrification, I think we're going to see over the next year Tesla margins come down big time, because you had these like big one-time benefits. Like Tesla can't just keep raising the price of the car, because I think we're reaching that point where, especially with loan rates now rising off zero, right? Like if you're taking out $100,000 loan or $75,000 loan for a car at 4% versus 1%, it starts to really add up. I have very strong feelings about Tesla, obviously. So I do think it's a disaster waiting to happen. When I think about it being valued at $700 billion still, and the proponents of it will note, yeah, we think it's going to keep growing 50% for many years to come. I think I've seen the Gary Black guy note he thinks that Tesla will maintain 20% global EV market share in perpetuity, and I think a lot of these assumptions are very optimistic. And it gets back to my view that okay, what's the upside, right? You're at 700 billion. You're already worth more than every other automaker combined, or at least all of the kind of the top, what is it, 5 or 10 combined. Yes, it's a different vehicle architecture, but are we expecting that they will not face competition? I mean, I think it's clear competition is rising. So Elon Musk, I think a lot of people do simply buy Tesla because they think they're buying Elon Musk, not necessarily a company that 90+% of its revenue still comes from making cars. And when you go into a recession and you see consumer getting taken on the chin, they're typically not buying luxury priced automobiles or premium priced automobiles at the same clip. So it remains to be seen how the story plays out. Tesla could be a disaster, but certainly for people who were in on it early on, maybe they bought in 2013 and sold sometime in the last year or two, it wasn't a disaster, but they also had to wait many years of sideways movement depending on when they bought. So it really gets back to, again, what's your duration? If you're really truly buying and holding Tesla for 20 years, you might get a great return. I've made the corollary though that I think of Tesla like Cisco, and Cisco, if you bought it in the .com bubble, you've not ever broken even, which isn't to say Cisco's not a good business. It's still, today it's now almost a $200 billion business, and that's after what, a 30% drawdown from peak. So you can be a great business and you could not be a great investment. But
and on top of that Cisco note, you have to also keep in mind inflation. 200 billion in
exactly,
97
yeah. You
or
might have
whatever, and
had a
200 billion today,
return,
very, very different.
But your real return was pretty lackluster for sure. You're right. But that I think of Cisco just because I think it's like Tesla to me just reeks of Cisco.
Yeah,
it's not to say, I'm not saying Tesla's going to go bankrupt, right? I'm not Tesla Q in that regard, which they could have at one point gone bankrupt, and of course they didn't, and that's history. But I don't think Tesla can grow free cash flow at the necessary clip to justify, right? But what are other disasters?
Well, I think that is some.
Hear you, Mr. DCC.
Oh, I had yeah. Yeah, I was going to say about Tesla. I was going to say, the uh, it's often better to look at what the downside is and not really focus too much on what the upside is. And I think with Tesla, there's a significant risk that it can go down. And kind of like you were saying, I mean, how much more of the market share can it take, and how all these other things. What's the likelihood that it will grow versus the likelihood that it'll go down? And I think it has, if you only focus on downside there, it seems like it has significant chance of moving down in value. I wanted to say one of the things that I don't know, wouldn't call it blowing it up, but I had invested in Hyliion, which was a de-SPAC that was in the EV space, and yeah, it was just a disaster. I mean, I think the more that I got to know the company, and that's actually one of those things where it's really hard to understand a company until you've bought some shares of the company. Like until you have skin in the game, you really don't think too much about it. And luckily, I didn't lose that much money on it because my position was small. But it was a company. It still is trading and everything. But I think like the more I started to understand it, the less I thought was likely that anybody would use their products. And their board didn't seem like it was right people on it for what they were trying to do. But most importantly, what Hyliion is trying to do, or at least the last time I was reading about them, was that they would sell. They changed like fuel sources a few times, but at one point it was going to be hydrogen, like hydrogen fueled drivetrains, and then I think they went to electric. But that you would swap out on your semi truck to allow you to like get better better efficiencies. And really, I'm not an expert in long haul trucking or anything like that. Probably the least expert in the room, but it doesn't take. I don't think it takes like a rocket scientist or anything to think about it and say like, if I'm a company and I wanted to buy, convert my fleet over to this, how am I going to maintain it? What's the chances that I can get repairs on it? And, and who where can I, what's the reliability? And it's like extremely low. And if you're going to take a vehicle a semi truck that you might have cost 500 grand, swap out some components, do an aftermarket. I mean, it just seems nuts. It just seems nuts. So like that was something that I ended up getting out of when I realized that, and took my loss. But it was something I probably wouldn't have had I wouldn't have had that clarity until I invested in it. Really, I think I just didn't really understand it that much. And I know Buffett talks about buying 100 shares of a bunch of companies, and he would do this back in the day so he could get the annual reports, which nowadays with Edgar isn't really necessary. But having some skin in the game, even while minimal, allows us to have a slightly different perspective.
Do end up thinking differently about it than just being a sidelined observer purely. You should have asked me about Hyliion. I could have told you all about it. I think the point you made, though,
Yeah, I wish I did.
The product example is you have a very conservative industry that is to pursue maybe revolutionary innovation as they would prefer evolutionary, and to them to adopt something like this. And I remember when I was at Ryder talking with the director in charge of kind of new product strategy, and we Hyliion, and it never really got off the ground. It's just just a lot. It's really hard. Plenty of times before, I look at these industries, think of stuff like Tesla Semi, and I just don't think it's realistic to actually break in, because barriers to be a new entrant. I feel like I've said this before. Again, the EV companies, the EV startups are all. It's not to say that electrification won't happen, right? I think electrification has been at a pace and a clip, but that a lot of the capital is going to get destroyed in the period between getting from small scale to full fleet. Whether it's Rivian, Lucid, etc. All these other component. Hyliion's another example on the truck side, but like a lot of those, I think will either go out of business or they'll get acquired by an incumbent in the journey. And yeah, electrification will happen, but like.com, the internet happened, but many of the businesses went out of along the way. Obviously you've got the Amazons, but the likelihood of us selecting the right, the next Amazon, well, we all know that, of course, AWS wasn't even an idea that an investor would have had in their mind in 1999 or 2000, right? And it had luck and need luck, and it also had a lot of things more than just luck, but disaster stories out there.
While it's silent, if nobody else has a disaster story, I posted a link in the voice chat about I think it was at a 2021 annual meeting for Berkshire, where Buffett had put up a slide that showed there was back in 1903, there was, I think, somewhere between 200 and 500 automobile companies that were starting up. It would have been impossible to pick, the Ford or what eventually became General Motors or, what eventually became Fiat Chrysler. It would have been impossible out of those to know. And I think in the context of this, he was talking about, I think, electric vehicle companies. But so it's really hard. And right now, sometimes it can look very clear, but it's somewhat of a commodity, right? And so you're looking for who's the most efficient producer, what company, is a win-win-win for the customers, the company, and their suppliers. And it's a very difficult bet to try and make.
I'll read it aloud if folks aren't looking at their screen. But Buffett noted that there were at least 2,000 companies that entered the auto business because it clearly had this incredible future. By 2009, there were just 3 of these left in the US. And of these 3, of course, General Motors and Chrysler went bankrupt. So, you could have a view, right, that the automotive industry is going to be revolutionary, and we know that everyone's going to eventually have an auto, blah, blah, blah. Even if you knew that, with the benefit of foresight, right, having been able to pick Ford as the only one, right, and putting all your money in Ford, right, it certainly would have been difficult for the layperson to do. And yeah, I actually didn't even know that Ford was private till 1956, so they wouldn't have been able to buy Ford. So it's certainly hard.
Going back to the disaster stories, it made me really recall all of the work from home stocks. And when COVID was going down, everyone said, this is the new normal. Everyone's going to work remote now. You're going to work at home, work out at home as well, on Peloton. Look at all those stocks. You look at Zoom. You can look at DocuSign. These are all, people thought this was the future. Just a year ago, they thought, this is where everyone's going to be.
Peloton.
Every team meetings on Zoom now. That's what. Yeah, Peloton specifically is a big bust. Look at that. 783 or something.
Yeah, I think that's a great example. The disaster of everyone extrapolating that what was going on in COVID.
I remember I was
e-commerce adoption pull forward, and all the beneficiaries of that, and of course the the beneficiaries of remote work, people being forced to do remote work, which isn't to say there won't be remote work, higher mix of remote work, but like I think most people got it wrong in extrapolating, a once in a century pandemic instance into saying, yeah, this is gonna be the future for many years to come.
Yeah, I remember I was knocked out of I was still at the University of Connecticut, and I had a stock pitch competition, and this was back in September, October of 2020, and I had pitched GME. That was like the only stock I was really enthusiastic about, and I also thought it was a really fun one to pitch because it's total underdog at the time. No, it was no one that was enthusiastic about it, and I think Cohen had just gone public with his stake. But anyway, I was knocked out of the competition by somebody who ended up winning with DocuSign. And that was their pitch, was DocuSign. So if you look at a comparison, even to this day, I mean, you can see, yeah. And this was the end of 2020, around the end of 2020. So if you look at like October 2020, what DocuSign was trading for versus trading for now, yeah. I mean, and those are my professors, those are learning from that chose this stock over mine. I'm not saying anyone can see the future, obviously not. I don't hold any grudge there, but I just thought it was funny. I mean, if I had listened to them instead of making my own decision, my life would be very different right now.
Yeah, I'm highlighting the examples that Everard shares in his story that kind of led to this disaster discussion, and we can wrap it up with one last question afterwards. But quote, to the extent that we've been successful over the decades, it's due mostly to what we did not own. We owned no Japanese stocks in the late 80s. We owned no tech in the late 90s. And we didn't own any financial stocks to speak of between 2000 and 2008. So the book says, his ability to sidestep those three disasters over 3 decades made all the difference between failure and success. Because, to that example of DocuSign, if you had bought DocuSign at 200, let's call it, and now it's down at 50, you've gone down 75%. And now to get back, the stock doesn't go up 75% to get you back where you were. You needed to go up 400%, right? So the brutality of math.
Yeah. And it's funny because I mean this is I was pitching GME, and I think it was trading for between $9 and $11 is where it was. It was in low single digits and or low double digits. I mean, and there was just so little downside to even imagine. I mean, the stock wasn't going to go back down to the COVID lows of like. There's no way. Could it have gone back down to $7 or $8 maybe? Anyway, it was just so that's even still just 30%. And there's no way it could fall as much as DocuSign or these stocks that were super inflated at the time working.
Good disaster stories. I'm going to let us wrap then, and I'd love for folks who haven't had a chance to chime in to maybe give it some thought and share a remark if you're willing to. But the epilogue, I noted earlier, it was really my favorite part of the book. Talking about the Holocaust survivor and his experience in his life, but kind of highlighting what do you think makes someone rich? Because to him, it was not the assets under management. It was not the idea of him selling his firm for millions and millions of dollars. It wasn't him having the financial wherewithal to buy a Mercedes Benz. It was all of those letters he got from his investors and from the people he had a positive impact in their life. What do you think makes someone rich? Blog, if all you succeed in doing in life is getting rich by buying little pieces of paper, it's a failed life. Life is more than being shrewd in wealth accumulation. Charlie Munger. I'll share because it definitely helped lead me on this path and this journey that I'm on. I remember in January of 21 with the GameStop story crescendoing, and just how incredible it was to get dozens and dozens of personal stories that people shared with me about how impactful my research and my advocacy on behalf of the stock was in their own life, and whether it was a university student being able to pay off all his debt. It was people all over the world. It was incredible. I didn't necessarily realize the impact of all the things that I was doing in leading up into that. And obviously I made more than $2 million, and most of it's in retirement accounts. So I'm quite well, and even having drawn down meaningfully from the highs, I'm quite well in financial wealth. But take that aside, I would much prefer having a positive impact on other people's lives. that is much more enriching for me than just, like Charlie said, having a bunch of pieces of paper on a ledger somewhere. What do you think makes someone rich?
Yeah, I can agree with that personally. I mean, after everything went down for me with the meme stock mania, I really realized, because I've been saying if only I had money, and then now I did, and it didn't change, and my day-to-day life was the same. So you really have to find a purpose somewhere else.
Can make one much more enriched in their life. The example the book shares is who you spend time with, right? If I spend a lot of time on social media, and I do enjoy it, and even though there are negatives to it, honestly, I think on net it's a positive for me. And I shared that story, of the people who reached out, and while there'll likely never be something quite like that again, it's definitely informed my thinking that I enjoy doing this. I like helping people in that way, and hopefully, whether it's sharing a nugget of information or making them think about something in a new way they hadn't before. And it's hard to know that stuff, unless you get feedback from people. But that's much more enriching for me. No one's going to bite on what they think. Yeah.
No, can you hear me?
Again? Just trying to chime in. Yeah.
Yeah, can you hear me, Rod?
Yes.
I don't know if my mic's on. I switched to my phone here. Yeah, I would just add that you really have to find purpose elsewhere. I don't think finance is it reduces everyone to numbers, and just having more money than the next guy is never going to make you feel any better. Personally, I've had much more fun sharing the GameStop story than spending the money. I love telling people about it. I love everything that happened. I thought it was really a magical time in my life, and I know it's a unique situation, but for me, that's where more of the joy came from, was just the friends that I kind of made along the way. And I mean, to this day, Rod, you and I talk every day, and we weren't friends until GameStop went down. So it was great to see all the things that came out of it. I know most investments aren't going to turn out that way, but yeah, there's more to it than the money.
Well, look, I'll leave it at that then. I think that this is a good point to pause and wrap our first book club. I think this is really a great book for everybody. Like I said, if you're anywhere on the spectrum of experience, I think it's worth a read. And whether you're an investor who's mostly passive and just wants to get some different ways of thinking and not necessarily manage your portfolio actively, I think anyone can benefit from it. And yeah, I think the last sentence in the book, right, in that blog, that's how I feel. I could it wouldn't be fun to lose the money, but I still would have had these positive impacts in the work that was done, and I think the work that we're going to continue to do with Wook. And again, it is very novel what we're trying to do. We have private capital that we are looking to, of course, grow, but we're trying to do it with chiefly retail investors in a transparent, collaborative, and an open manner. And we understand it's going to take a long time to build up and get to a scaled state, if you will. But for those of you who joined us on our first book club, we appreciate you. We definitely we value your time, and we want to get better at doing these things. Understand like what are ways we can add value to your day, your month, your week, whatever it is. We've got this Wook and review process. We're doing these weekly calls. We're doing this monthly book club. If you have any ideas for things we can do, we're obviously have other things in the works, but please share feedback. Feel free to invite friends or family members to the server who you think may benefit from this sort of a setting. As I'm sure you've noticed, it's a lot slower pace than some of the more hyperactive Discords. I hope it will stay more like that, and that it can be maybe people sharing reports and things they're seeing, and it's a little more laid back. But that we're all kind of learning and getting better as investors and just people over time together. And we're obviously, Joe's a young guy, Han and John are young guys. I'm the oldest one on the team, and I'm 33. So we have a long runway ahead of us to do this. So we're not gonna burn ourselves out, but we're gonna be at this for many years to come, hopefully. And we welcome you all to be part of the journey together. And thanks for tuning in to our first book club. We will circle back on what is next to come, and you will hear more from us on Friday when we have our 5th Wook in review.